we are a part of the stock market in all the time, even if we don't see it, even if we don't know that we are, y'all. Like, we're always buying something. Everything that we purchase affects the stock market. The more you buy, the higher the value of the piece of the company goes. So you might as well just own little pieces of that company. Hey everybody, it's Ashley of Stacks in the City, and this is a part 2. Well, it's just another part to the path, to the big investment path that we're gonna be talking about. We're in the midst of our investment series. Super excited to have you guys with me as I share all the knowledge that I know when it comes to investing and getting money and all that fun stuff. We did talk about exactly what the stock market is. Now we're going to talk about exactly what you should invest in, like building a portfolio or creating a basket of companies that you would want to buy and hold. So first you want to assess if you're a risky investor or a conservative investor. That's the thing, risky or conservative. And y'all, hint, hint, you want to be risky. You want to be risky. Generally, risky investors can invest in small companies, like companies that aren't well known, companies that aren't big, because the idea is with time, they're gonna get bigger and bigger and bigger. Whereas more conservative ones will invest in companies that have been around for a long time and ain't going nowhere. So you may not get the highest return on investment, so you may not get a lot of money back in the long run, but you know you're guaranteed to get money. Now the idea is that you should assess your risk tolerance based on your age. Try it based on your age. So the general rule of thumb is that you subtract 100 minus whatever your age is to get an idea of the percentage of risky versus conservative investments to have. So if you are 30, you subtract that. So it's gonna be 70% riskier investments and then 30% more passive ones. So risky investments, you all, are gonna be brand new companies, emerging companies, places, stuff you ain't never heard about. You don't know. You don't know if they're gonna be doing well or not. Basically, stocks are considered risky, can be risky as well. And more conservative vehicles will be bonds, which aren't traded on the stock market, but they are basically the debt. People sell anything. Companies are out here selling debt for you all to purchase, cash, bleh. And so remember that big mall I was telling you about? There's sections of the mall that you know you can get money back. So a really good example of that are your utilities. So there's a whole section of the mall where it's your gas, your electric, that boring dry stuff. Because you know that we're always gonna need gas and electricity and lights and all that. So it's a steady investment and is always, always, always going to go up. It just may go up as rapidly as some other companies that haven't been around as long or aren't necessarily a necessity or they're new. So there are other vehicles that you want to invest in as well. So once you figure out whether or not you're going to be conservative, or if you're going to be a passive investor, you're going to be conservative, or if you're going to be more of a risky investor, then you want to exactly find out what in the world you're going to be investing in. What in the world you're going to invest in? So I'm going to go over some very common terms, and I do recommend that you look into investing in these. So yes, we want to invest in sexy shares and all that fun stuff, but sometimes investing in shares of fun, popular companies are so expensive that it's not really worth putting all your money there. Or if you're a new investor, you may not have the money to buy a share. Like a share of Amazon is $2,000 for one little teeny tiny piece of the pie. Whereas there are index funds that go for about $200 a share, where you can buy, and then you'll have like a little fun little mosh podge. It's like someone picked out it's like a gift basket, and someone's already picked out the gift basket for you of companies to invest in. That's exactly what an index fund is. So you want to be a little bit smart about where you are investing in when you're first getting started. And what I would recommend for you all, and this is what Warren Buffett, which is like the Oracle of Omaha, recommends, is to invest in index funds. And index funds are basically, they are large pieces of companies into one. That's it. So like, instead of purchasing Amazon, you can buy a little package deal that has Amazon and Apple and other, and like Motorola, which in the same sector, so all the technology sector. That way you have a cute little variety pack of stuff. So if you don't like something, or something isn't going well, then you'll be good. So if something's not doing well, then something else could be. So you're like, all right, bet, I'm doing really well. That's something else I would recommend. ETFs, or exchange traded funds, are also another vehicle that do pretty well in the stock market. Again, it is a conglomerate of a lot of mini stocks in one. So that's the thing, guys. I wouldn't recommend necessarily buying one stock, because that's like betting all your money in one thing. We ain't got time for that. You want to have a little mix match, a little mosh posh of everything. What I recommend you all do is to literally Google like popular index funds. Google that, popular index funds, or popular ETFs, if you don't know their ticker symbols. So every company has a cute, fun code name, and the code name is called a ticker symbol. Research is really, really important. So when you're researching, literally just Google the company. So Google like popular ETFs, and then look at the chart. And if the little squiggly lines go up, that's probably a good investment, because it means it's going to continue to go up. That's it. And again, you guys, the investment isn't going to happen over a short term, but it will happen over a long term. So that's definitely something I want you to be cognizant of, because you're going to have a bad year in the markets. It may not necessarily work in your favor, but over time, it'll definitely help. And you all, the last piece of investment that I recommend that you all like at least be aware of are REITs. REITs stand for Real Estate Investment Trust. So basically, if you don't want to really plunge into the stock market, there are actually companies that will put some of their like shares of commercial real estate out into the market. Like, so you can own a piece of a mall. You can own a piece of Simon Mall or the outlets. That's what purchasing a REIT is. Just Google popular REITs or REITs that are doing well and just read about it. Y'all, it's not as hard as we make it seem. It's just unfamiliar to us. But just go for it, y'all. Do it. Let me know what you think. I'm doing the same as well. Like, I'm relatively new in the stock market world in terms of actively investing. So let's go. Let's get it.